At Insightful Value, we don't just chase hype, we spotlight overlooked companies with real staying power. And York Water Company is exactly that. You probably haven't heard much about it lately, but this 200-year-old utility stock is quietly trading near its lows. In this video, we're digging into why the stock has dropped and whether this old-school water company could offer long-term value. This review is for informational and educational purposes only, not financial advice. Be sure to like the video and subscribe if you enjoy clean, simple breakdowns like this. York Water Company is one of the oldest publicly traded utilities in the United States, founded in 1816 and still going strong today. It provides drinking water and wastewater services to more than 200,000 people in south-central Pennsylvania. Its business is about as stable and essential as it gets. People need water, and York has a near monopoly in the regions it serves. So what's going on with the stock? It's down over 20% from its recent highs, largely due to investor sentiment shifting away from defensive utilities and toward high-growth sectors. Rising interest rates have also weighed on utility valuations overall, and York hasn't been immune. But the company itself remains fundamentally strong. Revenues in the latest quarter grew over 7% year over year, driven by both organic growth and rate increases approved by regulators. Net income has been steady, and margins remain solid for a utility, with operating margins near 40%. York's financials are conservative. The company carries low debt relative to other utilities and has a strong track record of managing capital responsibly. Capital expenditures have been increasing slightly as York invests in infrastructure improvements, but these are largely funded through stable operating cash flows and low-cost financing. One of the biggest selling points for this stock? Dividends. York Water has paid dividends continuously for over 200 years. Yes, that's not a typo. And for the last 27 consecutive years, those dividends have increased annually. The current dividend yield is around 2.4%, with a payout ratio below 60%. For dividend growth investors, that's an attractive level of sustainability. So, is now a good time to look at York Water? On the one hand, you're getting a stable business with a long-term dividend history, low debt, and virtually recession-proof demand. On the other hand, growth is naturally limited in a utility business like this, especially one that operates in a fixed geographic area. Rate increases depend on regulatory approvals, and population growth in their service region is modest. Plus, utilities are interest rate sensitive. If rates stay high, valuation multiples could remain compressed. Still, when the market eventually rotates back to safe, income-generating stocks, names like York Water could stand out. Its small size and regional focus mean it flies under the radar of most big funds, but that's exactly the kind of company we love to analyze here at Insightful Value. At Insightful Value, we dig into undervalued and overlooked companies, break down the financials, and explain the real story behind the numbers, all without the jargon. Whether you're just getting started or refining your value investing strategy, our mission is to help you make smarter, data-driven decisions. For more analysis like this, visit InsightfulValue.com. You'll find deep dives into companies most investors aren't even talking about. And don't forget to like this video and subscribe to the channel if you want more sharp, clear insights like this.